this is Don Kaufman doing the TheoTrade weekend update, May 29th, 2021. Premium sellers, start your engines. I am going to describe why right now might be one of the best opportunities to sell premium literally in years, if not, if you will, decades. There is Skew, people, and I'm actually going to show you exactly where some of the really the heaviest premium kind of lies and what's most effective to be able to sell right now. With that, though, in this weekend's update, I'm going to start with a quick market update here, a couple of sector expected moves, more stagnation in the ultimate marketplace. So start with the spiders and the S&Ps in general. So if I actually cruise over in this case to the SPX, which I think even displays it better than the spiders, because I've got hand-drawn expected moves on here. You are well, how many weeks have we gone through? There's 1, there's 2, there's 3, there's 4, there's 5, there's 6, there's 7 weeks. 7 weeks inside of the exact same trading range. One of the things that I'm going to point out here momentarily is, as this trade kind of stagnates inside of the exact same range, and you're really, roughly speaking, in about 100-point SPX range, which, you can look back for a pretty significant period of time here in terms of the SPX and not see this tight of a range for, again, a very considerable period of time. In fact, you've got to actually go back into a 3-year chart and tell you what, you still do not see this much trade stagnation. There are periods of time, and I actually wanted to zoom back to this for just a moment. This period of time back in 2018, we got into what we actually termed like a little bit of a volatility box. This was, though, some pretty hostile volatility prior to the market ultimately breaking down. Nevertheless, this is an even tighter range, but we're not actually displaying higher degrees of volatility right now as the marketplace stagnates. Now, one of the things, though, that I want to point out, even before going into some more of the sector expected moves, is how risk is going to continue to perpetuate itself in this type of environment. And I cannot stress this enough, like on a week in, week out basis of actually talking about this, and how risk gets amplified and risk continues to amplify if you stagnate trade, especially when there's, well, high option volume. And so the SPX, I always call this like, it's the mother of all products. It's the mother of all products because, you're trading basically what? A $4,200 product, right? There's no stock to it. It's just the SPX. It's an options only product. So you're trading this $4,200 product and then just cruise down here. And, this last, Friday was nothing big, but it did trade 1.25 million contracts, which is average versus the previous 5 trading sessions. And again, if you've never actually seen this before, on thinkorswim, there's a slick little tool down here under trade analysis, shows you the number of option contracts traded, which is 1.25. Then you actually have what's called sizzle, and very few people actually know what sizzle means. And I was at thinkorswim when we actually built that, and the exact terminology in this very large part comes from me. It's today's option volume versus the previous 5-day option volume, and that's the exact build specifications, if you will, when we actually built that today's option statistics in there. In any regard, you see 1.2 million contracts, and you're like, well, whatever, man. But yes, but it's a $4,200 product. I realize that products like the spiders, and this is where I actually started the conversation here in the spiders. The spiders will do like, oh, it's almost 4 million contracts. Yeah, it's 4 million contracts though of a $420 product. Right? There's a reason I call the SPX the mother of all products. Now, if you start to actually think about this, though, you look at the spiders, okay, and the spiders traded 4 million. Then the SPX did what? Did 1 million. What did the VIX do? Okay, like how many contracts does the VIX trade on a day-to-day basis? And you start to look at the VIX, and the VIX is good for 400,000. In fact, that's even a light day. It's usually closer to 500,000. And you start to realize wow. All of these products are interrelated. And then you even look at the S&P options on futures. The options on futures trade some size too. Okay, all of these products are based on the exact same thing. They're based in the SPX. So when I talk about risk stagnating, okay, and or should I say the market stagnating and risk being amplified, the point that I'm making is a very, very simplistic idea. The longer you stay at one level, okay, the more the risk starts to build. Okay. And that amplification gets larger and larger. And you may not necessarily feel it, okay, right now, but you will. Because what occurs is that gamma risk continues to kind of build, right? So, how many trading firms are out there? I don't know, hundreds of proprietary trading firms and market making firms and retail clients and people. All we keep doing right here, right now, and this is why risk is getting amplified. What we're doing is just stepping on each other's feet. And while we're stepping on each other's feet, okay, meaning that the marketplace is just stagnating, we're just building open interest, heavier and heavier open interest. I usually don't go into like, specific option chains, start opening stuff up, but like the June option chain, and you can open up a ton of strikes in here. There are just there's billions and billions of dollars, okay, of options that have actually traded. But right now, because we are stagnating in the marketplace, the concentration of liquidity is right on top of us, which again, all it's doing is growing the gamma risk. And it's not just in the SPX, it's in the spiders and everything. All right, it's in the QQQ, and the correlations are, they're incredibly high at this point in time. So it's the most important thing going on inside of the marketplace right here, right now. And it's also one of the things that, nobody's really like thinking about talking about. All they look at is things are kind of stagnating. To kind of further this a little bit, I'll throw a slide at you. This is actually the OCC report, and it's from last night, so it's yesterday's trading session. So yesterday the volume kind of surprised me a little bit. It really picked up. So you're basically 42 million contracts. This is the total number of option contracts traded. You can see total equity, total index options. The index options really predominantly, that's the SPX and the VIX, right? Equity options includes ETFs. That 40 million would actually include none other than things like spiders and QQQs. But the point that I wanted to make with this and to really detail this right here is the 2021 year-to-date average, which is closer to 39 million. But May was actually a really, really light month. We actually traded just about 36 million contracts. Take a look again. Yesterday was totally dead day, right? Coming into a holiday weekend, nobody cared. Yeah, how come we traded 42 million contracts? What are you going to blame it all on GameStop? I know that people absolutely will. They'll email me and be like, "It's GameStop." And I looked at this too, so you can look at stuff like GME. By the way, it's not really GME that's trading the size in here. Okay, GME did about 300,000. It's actually AMC that did some serious size. Okay, AMC did good for 4 million contracts. You're like, that's where it's coming from. It's not though. I mean, most of these products have been trading some big size. So you can see that the volume out there has really been kind of amplified lately. And with that volume starting to pick up, all it basically does is accumulates more and more risk in a tighter and tighter zone. The bottom line with all of this, right, and we'll look at some of the sector expected moves, is that when we actually crack the range, there is going to be some serious movement in this marketplace. And at this point in time, you need to understand that there's no bullish or bearish in this conversation. I'm not gonna sit here and pretend to, hey, this thing's going up, it's going down. Okay. Risk is here. Like you can taste it, you can feel it, you can see it, right? When we crack the range, whether it's higher or lower, you will have, okay, no time to make real decisions in there. We're going to explode in this marketplace. And again, I want to be crystal clear that can be higher and or lower. We're going to rip through some of the expected moves. And we really, we kind of thought to ourselves maybe 2 weeks ago that was the game plan, right? We broke to the downside, I should say 3 weeks ago. 2 weeks ago, we did it again. It was actually 2 weeks ago we were going to test into some new lows. All of a sudden, right back into the range. Okay, there's only been brief and fleeting moments in the last 7 weeks we've been outside of this range. And it's serious at this point. And you're a coin flip away. And again, it's just hedging activity that's going to break us higher or break us lower. And that's why, I'm going to tell you, hey, listen, there's going to be a catalyst maybe that sets off the hedging activity. Maybe here's something about inflation, maybe something about the bond market and the Fed. Okay, there'll be a catalyst thrown into the works. And everybody be like, oh, it was the Fed. It's the risk right now that's building that's so dangerous. So again, trade stagnates, but that risk is going to continue to amplify. So in terms of sector expected moves, you can see that the S&Ps, they got close to the upper edge of the expected move. Nothing too crazy in there. Inside of the QQQ, if you go to auto expected moves and the Qs actually ended the week literally on the upper edge of the expected move. Is that close enough for you? Literally on the edge of the expected move. And you take a look at the little engine that could, IWM. IWM also, okay, closed pretty much at the edge of the expected move. And this one surprised us because it cracked outside and actually pulled back towards the close. So that's the major, index products. Then you start applying stuff to like, the financials. The financials, much to my dismay, continue to be rather resilient. Obviously, what led markets this last week was technology. The financials did get kind of dragged kicking and screaming. The point to be made here when we're looking at the sector expected moves, I don't want to go through every sector. I really don't, because I think it's a waste of time. I mean, right now it's tech and financials. That's all that matters. That's it. That's all that seems to matter right now is tech and financials. I know there's other sectors out there, but tech and financials are what are driving the marketplace. And here's the unusual aspect of that. In previous weeks, we actually saw a bit of a conversation piece where tech was up, financials were down, financials are up, tech is down. All of a sudden, they started moving in relative unison. Keep that in mind. So correlation is much higher now than it has been in previous weeks. So the risk is building, correlation is there. I mean, listen, the pieces of the puzzle. That's why I actually wanted to give it, a little bit of a market review and a market update, which I typically don't spend a lot of time on this, but it's important because we weren't correlated. Now we are actually getting closer to correlation. So this marketplace is actually ready to rock. Next thing on the docket over here, I was going to bring up the TLT and just talk about the TLT has been in an incredibly tight range. You're talking about the marketplace being in a range, but the bonds, I mean, come on, the bonds have actually been trapped in the same range since early March. But I have found it, again, a little bit interesting. If we cruise over here to studies, and I'll just do it the old-fashioned way, we'll go over here to studies. Bring up like historical volatility. Historical volatility is the annualized standard deviation of past stock price movement. It's down in the dumpster. Like there's just no movement right now inside of the bonds. But then, okay, if I actually pull up studies and we go to add study and go to volatility studies and go to implied volatility, okay, the implied volatility is how the option market kind of denotes risk. So I'll zoom back out. And what I wanted you to see in this particular context is there's actually pretty good implied volatility. Like the options marketplace sees some decent amounts of risk inside of the bond market, but the bond market is not moving. Now, that is one of the most simple ways to say maybe you should be selling some premium in there. But the marketplace and the TLT is actually also proclaiming we're getting ready to move. Think about that for a second, because the TLT, that premium is quite juicy for the bond market, and it's a bond market that is like one of the lowest instances of historical volatility. And the historical volatility, this is averaged over the last 20 days. You could tighten that up and go to like 5 days, but again, entertain the idea inside of the bond market that the bonds are not moving, but they're paying quite well in terms of implied volatility. Again, that range, though, we expect this range to be broken as well inside of the TLT. And what I am going to be doing personally is waiting for the range to actually start to crack and then go after some big premium sales. I think implied volatility could really explode inside of the bond market much more significantly. All right, so to really kind of kick into high gear over here, it's right now with a marketplace that's kind of stagnating, and I'll come cruise over to the spiders in this case. With a marketplace that's stagnating, what do you want to be? What do you want to be when you grow up? Okay, well, me, I want to be a premium seller. I've been a premium seller on and off for pretty much my entire trading career. The first 13 years of my career, I did nothing but sell premium, and things kind of dried up, with the Fed after the financial crisis. Now some of the premiums dried up, but they are very much back, baby. The other thing is, like, we're stagnating right now. So if you sold premium, you haven't been threatened. You haven't even thought about threatening. Okay, listen, premium, it just continues to burn. And that's the one thing that like nobody seems to really discuss over here, is that premium just continues to burn, and that's it. Well, especially if you're an index trader, and most of the major products out there, you can look at Microsoft, It's doing nothing. Premium continues to burn. You do Apple, yeah, it's doing nothing. Continues to burn. You want to look at Facebook over here? All right, it kind of broke to the upside, but there's been nothing statistically significant about any of the moves that we're seeing inside of the broader marketplace. Amazon maybe gave you a scare for a brief and fleeting moment over here, but after the earnings, absolutely nothing, people. Google, nothing. Even Tesla. Okay, even Tesla, including the earnings announcement, and Tesla, carries a little bit more premium to it in the 50 and 60% range. So premium and Theta just continue to burn. I am absolutely unequivocally positive Theta, which means, for all intents and purpose, selling premium and trying to manage the risk behind it. The additional aspect of that is if you've sold a lot of premium in the last couple of weeks, the volatility crush kind of helped you. Right? It did. The volatility crush helped you. One unusual aspect of this, though, is that volatility, even though the marketplace finished slightly higher on Friday coming into this holiday weekend, the volatility picked up, and it's actually quite considerable. You would expect into a holiday weekend, like, oh man, no worries, premiums are going down, like volatility should crush, except the volatility started to pick back up. The volatility crush that happened, though, was literally the last 3 weeks. We came off of almost a 30 handle on the VIX. We're right back down into the 16, 17 handle, right, which is actually helping suck more Theta out. So volatility and options premium kind of go hand in hand. I mean, they're the same animal, right? So when you look at Theta and what we call Vega, they also go hand in hand. The one absolute issue in here, though, with this is at this point in time, and I'll cruise back over to the SPX for a second, we have an allocation issue. We have a stagnation issue. And the stagnation issue is the longer you stagnate in a particular range, okay, you have to be very careful continuing to allocate. And this is what is going to be missed by a lot of premium sellers, and they're going to get absolutely rocked when we break the range. So although it's unbelievable right now to be able to sell premiums, like seriously, premium sellers, start your engines. Okay, you're basically in the exact same standard deviation. So this is the same standard deviation as this, as this, as this, as this, as this, as this. Okay, you're in the same standard deviation, people. Don't you see it? And if you keep layering more and more and more risk on, you're amplifying your risk the exact same way the trading firms are doing. So why aren't the trading firms concerned? They don't need to be concerned. Okay, they're using hedging devices and algorithms to hedge. You ain't got that. So a little bit, you need to be constrained. All right, it's a stagnation issue. It's an allocation issue. You need to be very, very constrained in how you allocate. You still want to sell premium, but you have to actually do it with a little bit of a softer hand right now until we actually break this range. All right, next on the docket, Skew. Skew is absolute highs. Very few people look at this on a day-to-day basis, but Skew, which actually is under the symbol SKEW. It's like dots on a screen. Dots on a screen. Why is it dots on a screen? Well, simply because it's only calculated once a day. But if you actually see the dots on your screen, go over to style over here, cruise down to style, go to candle, and under candle, you know what? Let's actually bring up area. Ooh, I like it. It's one of the highest skews ever recorded. Right, so that's what I wanted to bring to your attention. It's one of the highest skews. We'll even go back over like the last 10 years on a daily. Okay, you can go back until your heart's content over here. Okay, basically you have one of the highest skews ever recorded. If you have no idea what skew simply means, let's cruise to the spiders, go to an option chain. Open up an option chain about 30 days out. There's one right there. Actually pull up what we call implied volatility. So the implied volatility, look at the out of the money puts. Go way out of the money. Let's get crazy. Go way out of the money here. Okay, so what you're looking at when you're looking at Skew, all right, it's almost like a VIX for out of the money options. That's what it is, really. I mean, it's like a VIX for out of the money options. And when you're looking at Skew, and it's like a 155 reading, which is, again, it's unheard of. What it basically means is the premiums way out of the money are absolutely jacked in case of the puts. Like the puts are trading for a mass premium versus, for example, the out of the money calls. I mean, and you look equidistant in this case, and you'll see it. In fact, I'm even, when you measure Skew is really like 30-day look, but I'm going to go even further out in time. I'm going to go like 83 days out because I want to accentuate this a little bit. And you look, and the SPY is trading at like the 420 level. So if we were to go like $100 out of the money, now could the SPY move $100 in the next 83 days? Of course it could. I mean, it's poised to move 31, but, it can move that much. So if you take a look at this and you were to go $100 out of the money, that would take us to like the 320 puts. Look at the 320 puts. They're trading for like, what, 33 volatility? Go $100 out of the money on the call side. which takes us all the way, what, to the 520 level, okay? What are the calls trading for? And the answer is 2 cents. That's it on a 15 vol. So implied volatility in the puts is double what it is in the calls. Skew is absolutely massive. What should you be doing right now? Okay, premium sellers, start your engines. That's the theme over here. You got to know exactly which options to sell, but I'll tell you what, those puts, okay, they're pricing in mass tail risk. They're already pricing in tail risk. So people are always worried about selling puts, and rightfully so. The risk could be absolutely massive. So if you're going to go out and sell puts inside of the SPY, you better know what you're doing. And some people go, I can't sell puts. I don't have the margin capacity. Please, okay? If you're here at TheoTrade and you know a little bit about this, okay, you can absolutely sell puts. You can sell them naked. You can sell them naked in an IRA, and you can actually tie up, okay, next to no margin. Yeah. Figure out how to do that one, right? It's actually pretty straightforward. But, okay, you have to understand that this trade cannot go unhedged. You're going to have to actually mitigate your risk. So don't even worry about the margin constraint of selling naked puts. You have to worry about, ultimately the hedge. And we can actually use the VIX to mitigate some of the risk, okay, of what we're going to sell, both in the spiders, the SPX. And again, if you're concerned about margin, people, with a $2,000 account, you can actually sell naked options now. You go, but maybe I shouldn't do it. Really? Because it's already pricing in tail risk. What I'm saying is that Skew is actually saying that the market's pricing in a crash. So even if the market did crash, you're already getting paid for that. Like, do you not see it? It's 40% implied volatility. This is 48 days out. Let's get crazy. Let's even go like 111 days out, because I want to show you. Look at some of these options. It's insane levels. Like Skew, it's utopia for it. So again, index puts are just trading for absolutely unequivocally mass premium. You just have to know how to do this the right way. Last but definitely not least, we come, of course, back to the SPX, where we started, okay? The mother of all products. What did the SPX do this last week? Not a lot. And I got to tell you, okay, I expected more and more volatility. The coming week, the expected move actually drops to $50. Why? Well, it drops to $50 simply because we're coming into a holiday week of trade. It's a 4-day week, so obviously this is the Memorial Day weekend. The equity markets are going to be closed on Monday, but you're looking for a $50 move higher or a $50 move lower coming into this next week of trade. Again, extraordinarily tight range. And you should expect chopped out fast, what I would say a broken field to trade. You've seen that a tremendous amount. It's just a gap-filled wonderland from like day to day in here inside of the broader marketplace. Now, again, a lot of people are not talking about that. So, little gap here on a day-to-day basis. Obviously, the SPX is only open during currently market hours. Nevertheless, okay, keep your head in the game right now, because with this much gamma risk having built, okay, people, we are ready to rock. I've been talking about this for a couple weeks. 3 weeks ago, I was like, oh, this thing is ready to go. And we did, and we moved huge. And it just popped right back into the range. We go, okay? There's no going small. It doesn't matter whether we're at the higher end of the range or the lower end of the range. Okay, when we make this move, you're going to know it. You're going to feel it. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful holiday weekend. Bye-bye.